Hi, and welcome to the first quarter 2014 Strategic Equity Management Economic Update. My name is Jeff Hybeck, and I'm the Portfolio Manager for Strategic Equity. Now, today's update is actually going to be a little bit brief because we have some question marks as far as what's actually happening with economic data, and we're going to talk about that today. Now, if you'll recall, last quarter we saw that we were finally starting to see some economic growth above trend, and what we call above trend is anything above 3%. And that was really encouraging to us. Unfortunately, we've seen weather either be used as an excuse or an actual problem for our economy that must be overcome. So we're going to break down our leading economic indicators and kind of give you an idea of where we see things happening, so that as we move forward into the rest of the year, we can keep an eye on some of the strong areas and also some of the weak areas in our economy. Now, last quarter, as I mentioned, we had very strong economic growth. We were finally looking at our indicators pointing to somewhere above 3%, actually closer to 3.2%. But the weather impacts have already started to play a big role in the direction that we see some of these individual indicators going. And the way we look at it is we want to break down our 9 economic indicators as far as what type of growth this individual indicator is pointing to give us an idea of overall where we're at with the economy. So the first couple indicators, above trend growth, which we call again 3% or higher, we only have 2 of them. We have supplier deliveries, as far as how quickly suppliers are able to deliver on their orders, and then we have stock prices, and that's it. Stocks continue to point towards very strong economic growth, and we're going to talk about why they may be pointing to growth that may not be sustainable here in a minute. But that's important to know, is we only have 2 indicators of the 9 pointing to above trend growth. The others are all at or below trend growth, and you want to look at some of them, such as payrolls. They're growing at a decent amount, but they're not growing at a rate that we can consider being strong enough to jump up and down about. We also can say the same thing about consumer goods orders. You're not seeing the consumer pick up and really get confident enough in the economy to support the rising stock prices. Also, you have building permits. Building permits, yeah, they're impacted by the weather, but a permit is just an idea that they want to build a house, so that's not going to be impacted as much by the weather. And we've seen a noticeable slowdown that started well before the winter. This actually started back in August when we saw mortgage rates spike, and they really haven't improved much even as mortgage rates have drifted down a little bit. Now, the next set of below trend growth indicators are something that we need to watch very closely throughout the next quarter. The first one being capacity utilization. Now, we talked a lot last time about how we don't believe the sustainable trend in capacity utilization points towards strong economic growth. What we've seen is we saw a very productive society in the 80s and 90s now start to kind of go into this period of slowing, where even when capacity utilization improves, it's still significantly below where it was at even back in 2007 or all the way back to 2000. We've also seen that impact the number of hours worked. Hours worked is a key indicator for future growth of employment, and that also has not improved very much. And then that's filtered down into consumer confidence. We've had weak payroll growth, we've seen weak personal income growth, we've seen the number of hours not really pick up like it needs to, and that's turned into a consumer that's just not confident. And we need to see a consumer that's more optimistic in order to believe that we're going to get into a type of growth that the stock market is pricing in. Now, finally, we do have one indicator that I consider being at stall speed, and this is a big concern because it comes from the service sector, and that's the business activity index. Has slowed so much to that it's actually pointing towards a contraction. Now, as most of you realize, the service sector is about 70% of GDP growth. And so if we see a slowdown there, that can be a big concern, because the service sector has been one of the key areas that has led to some strong growth. Now, overall, when you take the net of all these indicators, based on our historical studies, you're looking at about 2.8% GDP growth, which is down from about 3.1% growth that we were looking at in the fourth quarter. So it's still decent growth, but it's now back below trend, and that becomes really important in a number of ways. Number one is the Fed is trying to use policies that are targeting GDP growth around 3.2%. The Congressional Budget Office and all their budgets uses a 1 to 3.2% growth rate in any budget that they have. And so we keep that blue line there on this chart to see how are we doing versus the trend. And you can see, despite all the stimulus we've seen, both from the Federal Reserve and the federal government, we have only had 5 of the 18 quarters thus far in this recovery actually be above trend. And we're going to talk about the Fed and their role in this in the second part of today's presentation. But what we're looking at is an economy that has struggled even to get back to 3% trend. And it may be, as we discussed last quarter in our update, and if you haven't seen it, check it out on YouTube or at semtradersblog.com. And what we talked about is how there's structural issues with the economy. Now, the Federal Reserve is trying to fight some of those structural issues, and all we've really seen them be effective at is stimulating stock prices. This chart here shows how the stock market has done versus the Fed's balance sheet. Now, every time the blue line goes up, the Fed has been doing quantitative easing, and I overlaid the different versions of stimulus the Fed has attempted. And I noted there on the chart, once they started tapering at the beginning of 2014, we've seen a lot more volatility in the stock market. We saw a big drop in January, a rally back in February, and now a lot of volatility so far in March, because the main thing that people are, the banks are doing with this excess money is they're putting it to work in the markets, either by buying treasury bonds, flipping those back to the Fed, and then having those excess profits inside of their investment divisions, or just outright buying S&P 500 futures contracts and things like that with their investment divisions at the bank. So besides stock prices, I think the real question is, has QE3 even worked? This was the policy that was started in September 2012, and it's something that really most people look at as saying it has been successful because of the growth we've seen in the stock market. But when you break it down, and this is what I wanted to do there, is let's see the impact QE3 has had. First off, let's look at the Fed balance sheet. It's grown from 2.8 trillion all the way up to 4.3 trillion, which is an additional $1.4 trillion of money the Fed has created and put to work in our economic system. Now, you look at the bank reserve balances, which is the money that the Wall Street banks hold in their Fed accounts. That's increased by 1.1 trillion. So you can see only $300 billion of the money the Fed has created is actually entered circulation. Let's talk about rates. 10-year rates. That's what the Fed supposedly is targeting. We've actually seen 10-year rates shoot up from 1.65% up to about 2.78 to around 2.8, depending on which day you look at them. So that's 113 basis points higher that we've seen rates go, which is the exact opposite impact the Fed is wanting to have. And we talked about what it's already done to building permits. We're seeing new home sales start to slow down. We're seeing existing home sales slow down. And most importantly, we're seeing consumers not confident enough to go and spend money. And that has nothing to do with the weather impact. And that's something we need to keep an eye on. Speaking of housing starts were rising at a 51% year-over-year rate back in September 2012. That is now down to a 7% year-over-year rate, which is still a nice healthy clip, but it's less activity than we were seeing when QE3 started. And that's something that the Fed, I think, should look at closely and say, why are we not having an impact? And it goes back to 10-year rates. Rates have gone up too much to support the housing market. Consumer spending was growing 4% year over year when QE3 started. Now it's only 3.5% year over year. Again, it's the money going to Wall Street is not trickling down to everybody else. Payrolls. We were looking at a 12-month average of payrolls, 178,000, which is a moderate pace. It's not something that you would call spectacular, but it's also not something you would call contractionary. That pace has only grown by 1,000 on the 12-month average, so it's really had no impact on payrolls. The big impact, again, stock prices, up 29% since QE3 started. So if you look at all those numbers there, you can see it's a very limited impact on the overall economy, except for the stock market. And that should lead people to ask the question, why is it not filtering through the rest of the economy? And it's something that I think the Fed is really missing the boat on. And these are charts that I've shown in the past, but I wanted to update them here and look at why is QE not working. First of all, the velocity of money. Velocity is just basically the frequency that one unit, in this case $1, multiplies it and expands in our economy, and it's just not having the same impact. In fact, if you look at that chart, you can see it actually peaked back in 1997. And that was, of course, when the first major crisis developed. In this case, it was in Asia, and the Federal Reserve stepped in to try to smooth things out. And since that time, we've seen money that gets put to work by the Fed in our economy have a lesser and lesser impact. And so as the velocity of money slows down, it really throws off all of the Fed's models. So they're doing things that they think are going to work, but because the velocity of money continues to decrease, it's just not having that impact. And a better way to look at it is the money multiplier. Now this takes a look at both what Fed stimulus has done, as well as government stimulus as far as spending goes. And the Keynesians like to say, if we're in a recession or slow growth, the government needs to spend money to try to stimulate things. But if you can see, the money multiplier is actually turned into a divisor. And what's happening there is a really simple economic lesson is if the US was a closed system and money was put to work, that money would multiply, because say you hire a contractor to work on a road. That contractor would go to the store, they would buy things that were all produced in the US, and then they would turn around and then that store would have extra money, the suppliers would have extra money, they would hire people, and you'd see that money multiplying. Well, what we have now is the US economy is so global that we have some very big leakages, and they come from our deficits. Both of our government deficit, where we're borrowing money from other countries, so that when we generate extra money, some of that money has to leave our system and it has to go to pay back our debt. Money, as most of you know, if you're paying down your debt, that's not money you have to spend. You're not getting anything extra out of it. You're paying for things that you already bought. Well, if you look at this chart, you can see that we've been having to pay back all of our growth from the 80s and 90s, and that's having a big impact on the money multiplier. The other leakage is our trade deficit. Remember I mentioned if we were a perfectly closed economy, we would be buying goods from domestic producers. Instead, because of our massive trade deficit, which is also the result of our massive spending deficit, we are having to continue to import more than we're exporting. So you're seeing money be put to work into our system that's actually leaving, and so that's why you have a negative multiplier. And now the Fed doesn't see that. They're continuing to use multipliers that are positive. They're continuing to use a rising velocity of money, and when that's not happening, they keep trying to do more and more and more, and that's actually making things worse, because the Federal Reserve is enabling the government to spend more money than it's taking in. And so that is a big issue going forward for our economy, is we are seeing the Fed taper QE. They're not telling us why, but I have a sense that they are tapering it because they feel that QE3 is not having the impact that they believe it could, and it could be doing more damage. And so that's something to watch in the next quarter as we move forward. Now, we cover these topics and a whole lot more every day on our website. You can go to stratequity.com, click on the link either if you're an investor or a professional advisor. Register once, you get an email, always check your spam folder. You click on there to confirm that you're not a robot, that you're actually a human and you're not trying to spam us. And then you can log back in and you can check out our traders blog. There's a link off to the right of the page that says Trading Desk Update. You can also come back every Friday and check out our weekend podcast that we do, where we just talk about what's happening in the market. We don't know going forward how much of an impact the weather has had. What we do know is stock prices are pricing in a very good economic recovery that just hasn't happened so far. So we are active money managers that try to make money while the market's going up, but we also want to mitigate some of the risk that's being taken inside the stock market so that we can try to hold on to some of those gains. So if you want to learn more about our company, check out stratequity.com. Until next quarter, my name is Jeff Hyback. I am the Portfolio Manager for Strategic Equity, and I hope to see you again next time.